Hello everyone, welcome to our Egyptian Online Seminar Group. First, confirms off. Then, if you have any questions, you can ask our speaker during his presentation or after his presentation. I have great pleasure of welcoming you, Professor Shu Jiang. Shu Jiang is an associate professor of accounting at Duke University. His main research area including banking regulations, design of optimal disclosures rules, the economic consequences of accounting standards, and regulations in general and strategic communication communications. His work has been published into ranking journals, including Journal of Accounting and Economics, Journal of Accounting Research, Journal of Economics Theory, Management Science, and the Accounting Review. Now we will start our seminar with the Professor Shu Jiang.
Thank you very much, Mohammed. It's my great pleasure to present in this online seminar of economics, finance, and accounting. And that's why the paper I choose today, I hope will have flavor to the more broader audience of economics, finance, and accounting that are interested in disclosure issues. So this is joint work with three finance faculty members. Xu Wei and Xue Yongzhang is at the Central University of Finance and Economics in China, and Li Yan Yang is at the University of Toronto. So what we're doing in this paper is we're studying the disclosure effect on price informedness and cost of capital. While this question seems to be a well-studied question, the setting we're going to study today is going to be different and hopefully be more close to the real settings. So, as already mentioned, this disclosure of public firms, the capital market effects has been well studied, and usually such information is disclosed on a periodic basis. So let's say every quarter. And so when disclosure is made every quarter, then what the market participants they're going to do is, first, they're going to observe what has been disclosed. And perhaps more importantly for our setting, they're going to anticipate that some information is going to be disclosed in the future. And the prior literature, mostly they focus on the capital market effects of the public information that has been disclosed. However, the anticipation of public information to be disclosed in the future has received very little attention. And in particular, in settings featuring this Keynesian beauty context, and I'm going to explain this term in a short while. In general, the Keynesian beauty context means that you have the presence of short-term investors. So what we are doing in this paper is we study the capital market effects of periodic public information disclosure in a two-period model. Whereas in the prior literature, they only consider disclosure in the first period. In this one, we consider disclosure in every period. And so in this case, we combine both the effects of the information that has been disclosed and the information that is anticipated but yet to be disclosed. And the capital market consequence variables we study are two of the most commonly used variables in the empirical literature. So one is the price informedness. And no doubt, price informedness is one of the most important capital market consequence variables. It refers to how much price reflects the private information held by the capital market participants. And it will have significant impact on the real economy. Another variable is the cost of capital. And so, of course, cost of capital is fundamental to corporate decisions and to regulations, because one of the objectives of regulation is to lower the cost of capital. And so before we get to the main, to the details of the results, here is just a preview. So one of the things we find is, because we have a two-period model, so the information to be disclosed in the second period, more precise information of that is going to increase the price informedness in the first period. So this is in stark contrast to the previous literature. So previous literature find that the price informativeness actually doesn't really depend on the precision of disclosed public information. So it may seem a little bit counterintuitive, but I'll explain that in more detail later on. So the key mechanism here is more precise information to be disclosed in the future is going to alleviate this beauty contest effect. And I'm going to explain that in more detail. Now it may seem a little bit far-fetched. And so I'm going to talk in more detail about this beauty contest effect. But essentially, when we talk about this beauty contest effect, it means like short horizon. When investors have short horizon, they don't care about the fundamental, the long-term value of the firm. They care about short-term price. And so when they're making decisions, they care about expectation of short-term price, not exactly in terms of the expectation of the future value. And so, as we're going to see, when they're considering short-term price, the uncertainty of a short-term price is going to be higher than the uncertainty of the fundamental value. And because investors are risk averse, and so this beauty contest effect means that they're going to trade less aggressively. So that's going to result in reduced price informativeness. We're going to see later that more public information to be disclosed in the future is going to alleviate such effect. That's going to increase price informativeness. The second one we find is that the public information disclosed in this period, it could reduce the price informativeness when anticipating the public information to be disclosed in the future period. So again, this is different from previous findings, which find that the public information disclosed does not affect the price informativeness. And the key mechanism, as I'm going to talk in more detail later, is the public information disclosed in this period crowds out the positive effect of future period public information. And the reason is because investors, they anticipate public information to be disclosed in the future period. So they would put some weight on the future period public information when making decisions. But when the current period public information becomes more precise, then they're going to rely less on the anticipated future public information. And as a result, the future price is going to be more biased towards the current period public information because investors are going to put less weight on that. And because short horizon investors, they focus more on the current price. And because the current price is now more biased towards the current period public information. So the short-term investors, they're also going to put more weight on the current period public information. So they're going to rely less on the private information. And that's going to reduce the price informativeness. And so here, this reduction of price informativeness relies crucially on the crowding out of the current period public information on future period public information, which is different from the usual crowd out effect documented in the prior literature, which is concerned about the crowding out between public information and private information. The third thing that we do is we combine those two effects. We're saying that suppose you disclose information in both periods, and if you consider quarterly disclosure, it may not be an unreasonable assumption to assume that those information have similar precision. And so if I increase the disclosure precision in both periods, how would that affect price informativeness? And we actually find that in this case, more precise disclosure would always enhance price informativeness. And that just means the negative crowd out effect cannot dominate. And we're going to talk in more detail about the intuition later on. In terms of policy implications, we're just saying if the regulator's objective is to enhance price informativeness, then you should encourage regular information disclosure, but not unanticipated disclosure, even though that disclosure could be more timely. And also, there are some arguments about investors having short horizon or short term, and as a result, you may not necessarily want to disclose information more frequently because it's going to induce more managerial myopia in the presence of short-term investors. And we're just arguing that, at least in our setting, this concern of short-term investors, the beauty contest issue, is not an excuse. And we also show that for information disclosed in certain periods, it could enhance the informativeness of previous prices when you're anticipating such disclosure, but it will hurt the informativeness of subsequent prices. And then we talk about the cost of capital. So we focus on, because we only have a two-period model, so we focus on the second period information disclosure. How does that affect the first period cost of capital? And so the reason is we only have a two-period model, and so the effect of second period disclosure on second period cost of capital has been well documented in the literature. It's unambiguously negative. It's a reduction of cost of capital. And so we're looking at the first period cost of capital before trading takes place, and then before the disclosure takes place. And so following this Christensen et al. 2010 accounting review paper, we can decompose the first period cost of capital, which we also call the ex-ante cost of capital because it's before disclosure, as two components. One is the exposed cost of capital, another is what they call the pre-posterior cost of capital. We have two generations of investors here. So the exposed cost of capital is the cost of capital after the second period disclosure, which is induced by the uncertainty faced by the second period investors. And the pre-posterior cost of capital is faced by the first period investors. And so it's induced by the uncertainty faced by the first period investors. So in their accounting review paper, what they're saying is that the public information reduces the exposed cost of capital, but increases the pre-posterior cost of capital. And the reduction and the increase exactly cancels out. So as a result, the public information, the subsequent public information precision has no effect on the ex-ante cost of capital. And in our paper, we identify a novel channel because of the short-term horizon of investors, and we're going to talk in more detail about that. So the public information disclosure is going to alleviate this beauty contest effect, and so it's going to reduce the uncertainty, which means that the increase in the posterior cost of capital, which is induced by the uncertainty faced by the first period investors, and because first period investors, they are short-term investors, they have this Bayesian this Keynesian beauty contest, and so the negative effect on the pre-posterior cost of capital is going to be less negative, and so it's going to be less positive. So as a result, the public in disclosure is going to reduce the ex-ante cost of capital. So what we are saying is, at least in the assumption of the Christensen et al. Setting, if your objective is to lower the cost of capital, and then the investors with a short-term horizon is not an excuse for justifying less frequent disclosure. And when you relax the assumption in Christensen et al. 2010, which we're going to talk later, then the patterns can vary. And so in terms of a contribution, so we contribute to the reporting frequency literature when we explicitly consider this short-term investors. And prior literature on reporting frequency, they talk about more frequent reporting frequency has a negative effect, negative real effects. And this is what I call the Caronia type real effects. Because the Caronia type real effect basically means that the manager has all the information, the market does not have any information. So the market has to make inferences about the manager's information. So that's what prior literature does. And but the empirical results were mixed. So in our case, we actually show that it could have positive real effects because the pricing informativeness actually increases. And so what I call the Gaussian type of real effect would be positive. The Gaussian type of real effect, which means that the market contains information that the manager can learn from. So in that case, pricing informativeness is crucial. And we also contributed to the literature about what I mentioned, the capital market effects of public information disclosure. And so we analyze this frequent disclosure, this anticipation of disclosure in the future instead of just disclosure once and for all. And so we have some new effects. So now let's just get into the model. So we already mentioned it's a two-period model. And so it's a standard noisy rational expectations model. We have one risky asset and then one risk-free assets. And the rate of risk-free assets is normalized to 1. The return is 1. And then, as usual, we assume the risky asset has a random liquidation value and has a noisy per capita supply, just prevents prices from fully revealing. So the supply noise or the precision of the supply is gamma t, and that is going to be a crucial parameter, as well as the mean of the noisy supply. And then there's a continuum of investors, and so there is a Cairo utility, the negative exponential, and the investors they're like short horizon. It just means that the period 1 investors they have to sell at period 2, and then period 2 investors they sell at the end of period 2. And so, in terms of the information structure, we assume the risky payoff of the stock has an improper prior. That's just for analytical tractability. We have numerical examples which showing that similar results hold when we have proper prior. And then there's a public signal at the beginning of every period, just before trading takes place. And that's going to be a noisy signal of the fundamental value, theta. And the precision is alpha t in each period. And so those are also the key parameters. So the introduction of Z2 is the novel part of our model, because the previous literature, they introduced this signal Z1 before everybody trades. Here we have Z2, which is after investors trading the first period. So when investors trading in the first period, they anticipate a disclosure in the second period. And then each investor, they're going to observe a private signal prior to their trading. And so the private signal precision is beta. We assume here each investor has the same precision beta, and that's just for analytical tractability. And then the rest are pretty much standard noisy rational expectations model framework following, for example, Grossman-Stiglitz 9080 and then Vareka 9082. So given those asset prices, the investors, this is their investment decision, and then it's going to be the demand is going to depend on their expected payoff. And for short-term investors, their payoff is their expected value of the next period price, because they have to sell at the end of the first period minus the current period price divided by the variance of the second period price, and then times their risk tolerance. And then for the second period investors, their payoff would depends on the expected value of the fundamental minus the price that they purchased. And then the information structure for the first period, you observe price, you observe a public disclosure, you observe your own private signal. For the second period, you observe both period prices, you observe both periods public signal, and you observe your own private signal. And then as in the literature, we focus on linear equilibrium, which means that the price is going to be a linear function of the fundamental, of the supply, and of the public signal. And as in the prior literature, so investors can make inference from prices, and price will be informational equivalent to a noisy signal of the fundamental. And so because price is a noisy signal of the fundamental, how much noise is in the price determines the price informativeness. So as you can see here, the noise term is a normally distributed noise. And so it has this variance of this form, 1 over CT over DT squared gamma T. And so the price informativeness is the precision of the price. So that would be CT over DT squared gamma T. So what is CT? CT or C1 and C2 is the weight you put on the fundamental. And what is DT? DT or D1 and D2 is the weight you put on the supply noise. So essentially is how much weight you put on the fundamental versus how much weight you put on the supply noise. So the more weight you put on fundamentals, the more informative the price is. And so the price informative in the second period, it's independent of the disclosure quality of both the first and second period public information. And this is consistent with the prior literature. And so it may feel surprising if you see this for the first time, but let me explain the underlying intuition. So the price informativeness depends on how much weight you put on the fundamental. And this fundamental is the aggregation of all the traders' private signal, because traders' private signal is fundamental plus some noise. And so when you aggregate all these noises, aggregate out, so that leaves with the fundamental. So this price informativeness, which depends on C2, it really depends on how aggressive each trader trades. If each trader trades more aggressively to their private signal, the price would put more weight on their private signal, and when aggregate out, it would put more weight on the fundamental. And so the trading intensity of each trader with respect to their private signal can be decomposed into those two terms. So the first term is just the risk tolerance. If you're more risk tolerant, you trade more aggressively. And this has nothing to do with the private signal. So, or the public signal precision. So those with the public signal precision are the second two terms. So the first term, which is the precision of theta conditional on the private signal. So for this one, this is essentially from the trader eye's perspective. What is your uncertainty about fundamentals conditional on all the information you get? So in this case, more precise public signal is going to reduce the uncertainty investors face. So that means this uncertainty is going to reduce. So the variance is going to reduce based on more precise public signal. And so investors are going to trade more aggressively. So that will be higher price informativeness. So this term is increase in the precision of the public signal. But at the same time, the second term is based on your information, what's your expectation of theta, and how sensitive it is to your private signal. If the public signal is more precise, it reduces your reliance on your private signal because you're going to put more weight on public signal. And as a result, you're going to trade less aggressively on your private signal because your expectation conditioned on your information, your public signal and your private signal about fundamental is going to be less sensitive to your private signal. So that's going to reduce the price informativeness because you're going to trade less aggressive on your private information. And in equilibrium, those three effects perfectly offset. So there is no effect on price informativeness. In one sentence, the reason that more precise public signal does not affect price informativeness is more precise public signal, it increases your precision about fundamental. It makes you trade more aggressively, but at the same time, it makes you rely less on your private signal. So you trade less aggressive on your private signal. So price is going to reflect less of your private signal. And so the less reflection of the private signal plus the reflection of more private public signal, it exactly cancels out, results in no price informativeness. And so those are the cases when you have long-term investor, because this is second period. It's already a long-term. So you have long-term investors. There is no Bayesian, there is no Keynesian beauty contest. Yeah, there is no short-term investor. However, if you have short-term horizon issue, in that case, we're going to show that the price informativeness in period one is going to be smaller than when investors are having long-term. And so why is that? This is driven by the beauty contest. So the beauty contest is driven by the short-term investors. So short-term investors, they only care about the short-term price. They don't care about long-term fundamentals. The beauty contest effect, this term comes from this term invented by Keynes. So Keynes is basically saying investors in the capital markets, when they're short-term, they only care about short-term prices, which is what others think about what the fundamental would be, rather than the fundamentals. So he put an analogy on that to the beauty contest. So when you want to win the beauty contest, you want to guess the prettiest faces that others think are the most prettiest. You don't necessarily want to think the ones that you think are the most prettiest. So that's where the beauty contest term comes from. The beauty contest just means that investors care about short term. They care about the short term price. They care about what others think. So in this case, short term investors care about short term price rather than the fundamentals. And what is short term price? So this is the short term price. So short term price, they put some weight on the fundamentals, but they also put a lot of weight on the private signals. And so remember, the price informativeness is determined by the C2 as well as the G. But because once you have this private signal, the private signal contains noise in that. And so in this case, it's not exactly the coefficient with respect to fundamental, but also there is some noise. So in this case, short-term investors, they face this additional uncertainty about fundamentals because of the noise in the private signal. That's epsilon 2z. And so in this case, when you're facing additional uncertainty because you care about short-term price, and when you're risk averse, you're going to trade less aggressively. When you trade less aggressively, the price information is going to be lower. And so in this case, the public information precision of both peers is going to affect the price informativeness because it's going to affect how aggressively short-term investors trade on their private signal. And so what we show here is more disclosure in the second period is going to increase the first period price informativeness. And so that's in contrast to prior setting when you don't have anticipation of future public disclosure when this derivative is zero, which means the precision of the second period public signal has no effect on your first period price informativeness. And to see this again, we know that the price informativeness is determined by how aggressively the first period investors trade based on their private information. And again, you can decompose into this. And so you have a risk of total risk term. But those two terms, they're different. So the first term still, they would decrease with the precision of the future public signal. And why is that? Because more future disclosure is going to increase the uncertainty faced by current investors. Why is that? Because you're current investors. You care about future price, P2. And P2 would be determined by the future disclosure. If future disclosure is more precise, then P2 is going to be higher when future disclosure says it's good. And P2 is going to be lower when future disclosure says to be bad. And P2 is going to be to move more when future disclosure is more precise. So in that case, you are current period investors. You face a lot of uncertainty upon future disclosure. So in this case, when future disclosure is higher, the uncertainty is going to be higher. So you're going to trade less aggressively. So this exacerbates the beauty contest effect. The second term actually is going to alleviate the beauty contest effect. What is the second term? The second term, there's a ratio of the variance of theta divided by the variance P2. So this represents how close P2 is with respect to the fundamental. And so this comes from the short-term effect or the beauty contest effect. The beauty contest effect says, I care about short-term. So I care about the short-term price. I don't care about fundamental. But this term says, if the short-term price is very close to the fundamental value, then you care about the short-term is the same as you care about the fundamental value. So in that case, the beauty contest effect is weaker. So the beauty contest effect is alleviated. And this term is going to increase with future disclosure quality. Why? Think about extreme case, because extreme cases are usually the case that provides the most intuition. The extreme case is when you have perfect disclosure. Let's say when you have perfect disclosure, when the future public signal tells you exactly the fundamental, then P2 would exactly equal to theta. So in this case, there is no difference between care about short-term price and care about the fundamentals. So in this sense, more disclosure is going to bring P2 closer to the fundamental, and that's going to alleviate the beauty contest effect. And we're going to see that the second effect is always going to dominate. Why? Because the first effect, the more future disclosure is going to increase the uncertainty of the future prices. That's because of the beauty contest effect. Because there's beauty contest effect, you care about P2. That's why you care about how P2, how future price moves with respect to future disclosure. So this is caused by the beauty contest effect. So this is a second order effect. And then the second effect, whereas more future disclosure brings a future price closer to fundamental, which alleviates the beauty contest effect. This one is the first order effect. So that's why the second order, the second effect, which is the first order effect, always dominate. So that's why more disclosure in the second period always increases the future period price informativeness. The second result is, how would the second period disclosure affect the first period price informativeness? We actually show that in this case, more future disclosure, more precise future disclosure is going to reduce the first period price informativeness. And so again, this is in contrast with prior literature. In the prior literature, when there is no anticipated future disclosure, the price informativeness is of the first period is a constant of the first period price informativeness. And so why is that? Why? The reason is that, so first period price informativeness is determined by the first period investors' trading aggressiveness, how much they trade on their private information. And so first period investors, again, they're short-term investors. They care about short-term price. They care about the second period price. They don't necessarily care about the fundamental. However, we already talked about that. The second period disclosure is going to, more precise second period disclosure is going to narrow the gap between the second period price and the fundamental. So that's going to alleviate the beauty contest effect. So first period investors, they're going to anticipate that. Now, if you increase first period disclosure precision, then the second period investors, because they can also observe first period disclosure precision, they're going to put more weight on the first period public disclosure. They're going to put less weight on the second period disclosure. So in this case, the narrowing the gap between the second period disclosure and the fundamental value, that narrowing is going to be weakened, which means that the gap between the second period price and the first period fundamentals is going to be increased. It's going to be bigger. And so in this case, the beauty contest effect is going to be strengthened. So in this case, the first period investors, now they anticipate that the second period gap, the gap between the second period price and fundamental is going to be larger. So there will be more volatility of the second period price. And so as a result, they're going to trade less aggressively because they're facing more uncertainty. So in this case, the price informativeness of the first period is going to reduce. So this is what we call crowding out of future public information by current public information. So when you have more precise current public information, you're going to crowd out future public information. The second period investors are going to rely less on future public information. So the gap between the second period price and the fundamental is going to be larger. And so the first period investors, they're going to face higher uncertainty of the second period price. And so as a result, they're going to trade less aggressively. And so now, what we're looking at, suppose you have information disclosure in both periods, just like what you do with quarterly reporting. And so the precision is also the same in both periods. So if you want to increase the precision in both periods. Now, what happens when you have disclosure in both periods and both periods precision are increasing? Now, what happens to the first period price informativeness? We already know that increasing the precision of the second period disclosure is going to increase the price informativeness in the first period. But increasing the disclosure precision of the first period is going to reduce the price informativeness in the first period. And so what is the aggregate effect? We actually showed that more precise disclosure by increasing the disclosure precision of both the first period and the second period is always going to increase the price informativeness in the first period. And again, this is because when you increase the disclosure precision in the second period, it increases the price informativeness in the first period by alleviating the beauty contest effect. The negative effect on the first period price informativeness is because the divergence between the second period price and the fundamental caused by the beauty contest effect. So without beauty contest effect, you don't have this term. So the crowding out effect is based on the beauty contest effect, which means that it's a second order effect caused by the beauty contest effect. That's why the direct effect of alleviating beauty contest effect always dominates. So more precise disclosure always increases price informativeness. So this is about price informativeness. Now we talk about cost of capital. So cost of capital, following the prior literature, it is just defined as the expected value between the fundamental and the price. So higher price means less cost of capital. And so for second generation of investors, their cost of capital is just expected value of theta minus the second period price. For the first period, is expected value minus the first period price. So for the second period, the cost of capital is what we call exposed cost of capital. So it concerns about the conditional variance of theta on the second period information. For the first period, so you can see here is expected value of theta minus P1. You can combine that into expected value of theta minus P2 plus the expected value of P2 minus P1. So you have one exposed cost of capital, which depends on the variance of theta conditional on all period 2 information, as well as the variance of P2 conditional on all the information at period 1. So we call CC2 as exposed cost of capital because this one is the cost of capital after all the disclosure. And CC1 is what we call, and actually what Christensen et al. Called the pre-posterior cost of capital, because it's after the period 1 disclosure, but it's before period 2 disclosure. And so we're not interested in how disclosure affects the second period cost of capital. This has been well documented in the literature. More public information in either period reduces the conditional variance of theta, conditional all these public information. So it reduces variance to, it reduces cost of capital. So there is nothing to say about it. This is all prior literature. What we are interested is in the exented cost of capital, which has two parts: the exposed cost of capital and the posterior cost of capital. So I already mentioned when I'm previewing the results in Christensen et al. 2010, which is one of our special cases, when they assume this S1 upper bar over tau 1 is the same as S2 upper bar over tau 2. So the pre-posterior cost of capital and exposed cost of capital, this S upper bar over tau is the weights you put on them, because the risky supply represents essentially the amount of risk that you have to tolerate. The higher the supply, the higher risk you have to absorb. So that would affect the cost of capital. So they're the weights on these pre-posterior cost of capital and exposed cost of capital. They basically show that when these weights are equal, and then when there is no private signal, and then when there is no supply noise, which essentially means that the first period investor have to sell the whole share to the firm, and the second period investor hold until the uncertainty is realized. Then in this case, the exented cost of capital is independent of the disclosure precision. However, what we are showing is that if you have private signal and you have supply noise, what you would have is disclosing more public information in the second period is going to reduce the first period cost of capital. So what the reason is that in Christensen et al. 2010, what they're saying is more disclosure reduces exposed cost of capital, but increases pre-posterior cost of capital. So the two effect exactly cancels out. And the reason is that if I know there's a subsequent disclosure, and that subsequent disclosure is very precise, and so if the disclosure is very good, it's going to increase the price a lot. If the disclosure is very bad, it's going to reduce the price a lot. So the volatility is going to be the subsequent volatility is going to be higher. So ex ante, the variance is going to be higher. So the pre-posterior cost of capital is going to be higher. So those two exactly cancels out. We show that is when you have beauty contest, the positive effect on this one is less positive than that in the Christians et al. 2010. So the negative effect on the exposed cost of capital is going to dominate. So the first period cost of capital is going to decrease. And so the reason is that if you don't have private information, as in Christensen et al. 2010, the second period disclosure affect this pre-posterior cost of capital only through the volatility of P2, which is what I just described. However, in the presence of private information, the second period disclosure also has this noise reducing effect. When you don't have private information, your second period price only depends on the public disclosure. When you have private information, the second period price is going to put some weight on the private signal. It's going to put some weight on the public signal. And we already see that because private signal is a noisy information about the fundamental. So the private signal generates more noise of second period price. And that's the beauty contest effect. And so if the second period disclosure is of higher quality, the second period price is going to put more weight on public information. And when you aggregate out the noise of the public information, it's going to bring price closer to the fundamental. And as a result, the more second period disclosure reduces the noise in P2. And so because first period investors, they care about P2, whenever P2 is closer to the fundamental, it always reduces the beauty contest effect. And so it reduces the uncertainty P2. So it has a less positive effect on the pre-posterior cost of capital. So you have those two effects, and we can show that in the Christensen et al. Setting, when the supply noise is the same, in the sense that the prior mean over the precision is the same. So you put equal weight on pre-posterior cost of capital and exposed cost of capital. In this case, the excuse me, the ex-ante cost of capital is always decreasing in disclosure precision. But in the general cases, it's difficult to fully analytically characterize. So we resort on extreme cases to sharpen the intuition and present some results. So first thing is when alpha 2, when the second period disclosure precision is sufficiently large, second period public disclosure does not necessarily reduce pre-posterior cost of capital because the volatility of P2 is still large. So the volatility of P2 would depend on the disclosure precision of public information. When public information precision is sufficiently large, the volatility of P2 is still very large. So in this case, the Christensen et al. Increasing the posterior cost of capital is still pretty big. So more disclosure may not necessarily reduce the posterior cost of capital. So the effect, the noise reducing effect we document is not strong enough. However, the noise reduction effect is more likely to happen, which means that the reduction of the pre-posterior cost of capital is more likely when alpha 1 is small, when the first period precision of public signal is small. And the reason is we know from the discussion of price informativeness, when you have disclosure, public disclosure in the first period, it can crowd out the second period disclosure. But when your first period disclosure precision is very small, then the crowding out effect is small because your first period disclosure is not precise. People are not really going to put too much weight on that. So the crowding out effect is small, which results in the larger effect of beauty contest alleviation when you have more precise disclosure in the second period. So noise reducing effect is going to be large because in this case, when you increase public signal, investors are going to put more weight on the second period public signal. So the noise reducing effect is going to be larger. And so let's verify that by showing you some figures. So the first one is when alpha 1 is small. So you can see that when alpha 1 is small, when the pre-posterior cost of capital always decreases with alpha 2, with second period public signal. But when alpha 1 is large, then in that case, when alpha 1 is large, then the crowding out effect may be large. So in this case, you could have pre-posterior cost of capital increases with alpha 2. But when alpha 1 is small, when the crowding out effect is small, then in this case, the pre-posterior cost of capital will still reduces with alpha 2. And in this case, when alpha 1 is sufficiently big, when the crowding out effect is sufficiently large, you have the pre-posterior cost of capital always increases with alpha 1. And then when we further relax the Christensen et al. Assumption about this, and then in this case, then it's just like anything can happen. And so when S1 bar over tau 1 is much bigger than S2 upper bar over tau 2, this, remember, S1 bar over tau 1 is the weight you put on pre-posterior cost of capital. So in this case, of course, the pre-posterior cost of capital effect is going to dominate. So this will be the case similar to when alpha 1 is sufficiently large. When alpha 1 is sufficiently large, again, it's how the effective disclosure calling on pre-posterior cost of capital is affected by the disclosure quality. In the other extreme, then of course is the disclosure quality effect on exposed cost of capital dominant. So in this case, the exantic cost of capital is going to decrease with alpha 2. So again, we can show you some graphs. So this is a Christensen et al. Benchmark. So when you have S1 and S2 is the same, and in this case, they don't have gamma 1 and gamma 2. So you can think about the supply being fixed at 1. So you have to sell one share, short-term investor at the end of period 1, and then the period 2 investor keep the one share till the very end. There is no private signal. So in this case, this is exactly what Christensen et al. Has. The exantic cost of capital is independent of second period disclosure quality. And then here, this one again is when S1 upper bar and S2 upper bar is the same. When they're the same, when alpha 1 is not too large, the exantic cost of capital decreases with alpha 2. And then when S1 upper bar increases, then the pre-posterior cost of capital effect dominates. And so the exantic cost of capital would behave more like the behavior of the pre-posterior cost of capital. So anything can happen. They could increase with alpha 2, they could decrease with alpha 2, they could first increase and then decrease with alpha 2. So those are the cost of capital, how that varies with how it varies with first period public information precision with second period public information precision. Now, what if you have disclosure in both periods and then with the same precision and the precision is increasing? And so we know that the first period disclosure precision always reduces the cost of capital. This is from prior literature. When you disclose before you make the trading decision, the disclosure precision always reduces cost of capital. And we know that the second period disclosure precision reduces cost of capital when S1 upper bar over tau 1 is smaller than S2 upper bar over tau 2. So when this condition is satisfied, the cost of capital, exantic cost of capital always reduces with disclosure precision. And we also know that when alpha is sufficiently large, and when this S1 over tau 1 is much bigger than S2 over tau 2, we also have the cost of capital reduces with disclosure precision, and that's because the noise reducing effect is dominant. The noise reducing effect is dominating when the public precision is sufficiently large. So in that case, you put more weight on public information precision, the price is closer to the fundamental. And so again, you can see that this is when the supply noise is the same. You have exantic cost of capital always reducing in disclosure precision. However, when S1 is much bigger than S2, I mean, weighted by tau 1. So in that case, then again, anything can happen. Of course, when alpha is sufficiently large, the noise reducing effect dominates. You always have cost of capital reduces with disclosure precision. But when the precision is not sufficiently large, then anything can happen. You could increase, you could first decrease and increase. So this one is there is no unambiguous result. And we also extend to study the effect of more frequent public disclosure. And there is some sort of confusion and also different notions of more frequent public disclosure in the literature. So we talk about two types of increasing disclosure frequency. The first type is the more frequent disclosure also provides more information. So let's say previously you disclose information only every year. Now you disclose semi-annually. So in this case, you provide information every 6 months rather than every year. So in this case, more frequent disclosure also provides more information. Another way is what this Gigler-Hammer 1998 jar does. What they're saying is more frequent disclosure just change the timing of disclosure. It has the same amount of information. It will be something like, suppose previously I disclose semi-annually. So I disclose the first 6 month information after first 6 months. I disclose the next 6 month information at the end of the first year. But now what I'm going to do is, if I change to annual disclosure, I'm going to disclose both the 6 month results and the 12-month results at the end of the first year. So we can, because there are those two notions of increasing disclosure frequency. So we look at both. So the first one, which is more frequent disclosure, providing more information. And so in this case, the second period pricing formula is always the same. And that's from prior literature. The second period pricing formula is independent of the precision of public information. Because this is, it's kind of like, long-term investor, because second period is the final period. There is no beauty contest effect. And then the first period, the pricing formula is higher. And the reason is, what we discussed before. If you have more frequent disclosure in the second period, anticipating that second period disclosure is going to increase the period in this period. And then the first period cost of capital is also lower if you assume the supply noise is the same. And that's from prior results, because first period, both the pre-posterior cost of capital and the exposed cost of capital is low. The second period cost of capital is also lower. This is from the prior results. Of course, when you have put more weight on the pre-posterior cost of capital, the first period cost of capital may increase. And so we actually showed an example where for frequent disclosure, the cost of capital can be higher than single disclosure when S1 upper bar is sufficiently big, because in this case, the pre-posterior cost of capital effect has sufficient weight. So what we can see here is, at least from this numerical example, is when the supply noise in the first period is sufficiently large in expectation, frequent disclosure would have higher cost of capital. Otherwise, single disclosure would have higher cost of capital. Now, what about changes the timing of the disclosure? And so changing timing disclosure, again, second period pricing formula is not affected because there is no beauty contest effect. And when there is no beauty contest effect, the disclosure precision does not affect pricing formula, so it's not affected by timing. The first period pricing formula increases when disclosure is made later. And this comes from our prior results. First period pricing formula decreases if you disclose this period. It increases if disclosure is in the subsequent period. So when you make disclosure later, you're both reducing the precision of this period, but you're increasing the disclosure of subsequent periods. So both effects moves in the same direction. So it increases the first period pricing formulas. The second period cost of capital also decreases when disclosure is made later, and that's just because when disclosure made later, it reduces the exposed cost of capital. If you disclosure made earlier, it does not really have much effect on second period cost of capital. But the effect on first period cost of capital is ambiguous. And so what we could say is that when alpha is sufficiently large, you would always see lower cost of capital when you disclose early versus when you disclose later. And so this is essentially from the numerical examples. So what you can see here is when you disclose when alpha is sufficiently big, disclosing earlier always reduces the cost of capital than disclosing later, because disclosing earlier, it will be like reducing the cost of it will be reduce the exposed cost of capital, whereas disclosing later, you have this pre-posterior cost of capital, and it's also possible that you disclose you disclosing every period could have a lower cost of capital than you disclose very early. But you know that result is not ambiguous. I'm sorry, it's not unambiguous, it's ambiguous. And we also look at investors' welfare. So in terms of investor welfare, for second period investors, more information always reduces investor welfare. And this, again, this is not something new. This has been documented in prior literature. So why is that? Because investors, their welfare is reflected by their certainty equivalent, because they have the Cairo utility function. Their certainty equivalence is adversely affected by how much risk they bear. And so if you have more public information in the second period, it brings prices closer to fundamentals. So it reduces the trading gain. So it basically reduces the second period investors' risk share. So the second period investor doesn't really have much risk share, and it reduces their welfare. For the first period investors' welfare, which is first period a certain equivalent, it will be similar to the effect on the pre-posterior cost of capital, because first period investors, how much risk they would share really depends on the price volatility of the second period price condition on their information. So the pre-posterior cost of capital. So what you can see here is the result will be similar to the pre-posterior cost of capital. When your S1 is not very large, then the C means certain equivalent, which is proportional to investors' welfare. That's going to reduce with the disclosure precision. But then when for alpha 1 for the first period disclosure precision, but for the second period disclosure precision, it would be like the pre-posterior cost of capital. So it's like anything can happen. It could reduce then increase. It could reduce then increase then reduce, and then it could always increase. So that's essentially the investor's welfare. So now the basic implication. So first thing is the existence of short-term investors, which introduces the Keynesian beauty contest. That's not an excuse to preclude less frequent public disclosure, because we're showing that most of the capital market effects of pricing informativeness and cost of capital is beneficial. And then such increased pricing informativeness would also have beneficial real effects, which is what I call the Gaussian real effects, which depends on managerial learning from stock markets. So essentially the implication is, if managerial learning from stock market is more important than the market trying to infer information from the manager, which is the Caynesian real effects. So when Gaussian real effects is more important than the Caynesian real effects, then you may want to facilitate more frequent public disclosure. And so such beneficial real effects are more likely to be observed when investors are more heterogeneous and more risk averse, which is the case when the beauty contest effect is important, because the divergence of short-term price from fundamental has more adverse consequences on short-term investors. And then when the feedback effect is more important. But then we also show that the welfare effects is mostly negative. So most likely, so for second generation investors, welfare effects clearly negative. For the first period investors, it also have negative effects on a lot of parameter combinations. So essentially, in this case, there is a non-trivial trade-off for regulators. If you think about the capital market benefits versus the reduced investors' welfare. So capital market benefits, in particular, if you consider real effects, it may benefit investors. But then it also have, if you don't have real effects, it will reduce the investors' welfare, and that's a cost. So this is a non-trivial trade-off, and how to reconcile this trade-off, in my opinion, that's a very important question. And then in particular, in those settings with lots of short horizon investors. So to conclude, what we have done is we study this effects of periodic public information disclosure in a two-period rational expectations model with short horizon investors. Because you have this short-term horizon investors, you have this Keynesian beauty contest. And then, more importantly, we incorporate this effect of anticipation of future disclosures. And what we show is that the first period price informativeness is going to increase in second period public information disclosure. It's going to decrease in first period information disclosure, and that's in contrary to previous studies who find they're independent. And we also show that the second period public information disclosure, it can reduce first period cost of capital in the conditions when previous study find that there is no effect. And the implication is that the argument that investors they have short-term horizons is not an excuse against more frequent disclosure, whether in terms of pricing informativeness or cost of capital, in particular in cases when managerial learning from the stock market is important. Okay, so thank you very much for letting me present this work, and I look forward to having any questions from you.
Thank you very much, dear Professor Jiang, for your contribution and your efforts. It's really an excellent presentation, excellent paper. Thank you very much. Now, if anyone have any questions, you can open your mic and ask your question. Yeah. David, you have any comment?
Hi. I don't have any comments. I just want to say hi to Xu.
Okay, hey David. Yeah,
Yes.
yeah. Nice.
We met before in Toronto conference, Rotman conference. It's
yes.
Yeah, that was a long time ago, I think.
Yes, a long time ago. Yes.
Yeah, 2017, 2018. It's already 7-8 years.
Yes.
Okay, nice to meet you today. Okay, good.
There is some questions in the chat. Yes, I see. Someone asked about the heterogeneity of investor heterogeneity. Yes. Can you hear me? Did you show? Can you hear me?
You mean me or?
Yeah.
Okay, yeah, I can hear. Sorry. I thought you were talking to somebody else. Yes.
Someone asked about the investor heterogeneity.
Yeah, that's actually a good question. So in this case, investor heterogeneity is reflected in each investor having private information. But there are many ways of modeling investor heterogeneity. So one way is if they have different precision. This one, we have done some numerical results which we haven't put in the paper yet. I think more or less it's kind of similar. But what we want to emphasize here in terms of investor heterogeneity is if investors don't have any private information, which is an extreme case of homogeneous investors, then in that case, none of these results are going to happen, because in that case, even though investors, they care about short-term price, there is no such thing as divergence, because they're all focusing on public signal. They don't put any weight on their private signal. So in that case, the trade-off between public and private signal and the noise in private signal, and as such, the beauty contest effect driving price away from fundamentals does not happen. So that's why we need investor heterogeneity in this paper, in a sense, investors having private information, but that could be other ways of modeling investor heterogeneity, and this is something that we could do in future work. Yeah.
Other questions asking about what about the economic significance of the result?
Oh yeah, that's also a good question. So this is like a theory paper. So we did some numerical examples, but of course you'll always worry about whether the numerical examples is consistent with what is happening in reality. What we could do is we could try to maybe do some structure estimation of that, or maybe try to use some more empirically plausible parameters and then check. Right now, we're only focusing on the sign. It's just whether price informativeness increase or decrease with disclosure precision, whether cost of capital increase or decrease with precision, with public disclosure precision. We're more focused on sign rather than magnitude. But magnitude is certainly a very good suggestion that we need to think about. Yeah.
Other question about the study focused on the cost of capital, but neglecting the liquidity. What your opinion about this?
So this is a model where it's based on this, for example, Grossman, Stiglitz, and Varechia. So this is based on this perfectly competitive markets, which means we also have like a continuum of investors. So each investor is infinitesimal in affecting prices. So you take price as given. So you will learn from prices, but you cannot change your price. So when you're making your trading decisions, you take price as given. You don't think your trading is going to affect prices. So in this case, you have to think about this as market as infinitely liquid. So whatever demand you have, it would not change the price because you're like infinitesimal agents. If you want to address liquidity, you need to have some sort of imperfect competition. So each investor would be not infinitesimal parts. They would be a non-trivial part, so they could affect the the prices. So in this case, we do not really address that. There is a paper by Lambert, Lois, and Varechia in 2012 Review of Finance where they address the cost of capital in an imperfectly competitive setting. In that case, then liquidity would become important. In our case, you can loosely think about higher cost of capital being in some sense less liquids, but it's not exactly the liquidity where people are usually talking about. You typically think about this as a bad thing. Yeah.
Other questions about what is your opinion about doing event studies on disclosures, frequency changes, discussion of managerial initiative and behavior factors?
So in terms of behavioral factors, here we assume like everybody is completely rational in the sense of like Grossman and Stiglitz. They can learn from prices whatever information they can infer. They don't really have any information processing frictions. Incorporating behavioral factors would be interesting, and I'm working. Some of my recent work are actually related to that. There are a couple of ways of incorporating behavioral factors or behavioral frictions. One is introducing information processing costs. Let's say, maybe there is a friction for you to learn from prices. Maybe you cannot learn from prices. Or maybe you have some frictions in processing public disclosure. And all of these would change our results. But this will be interesting. And then I think another question is related to what's the first part of the question? I'm sorry.
Doing event studies on
event
disclosures.
studies. Yes. Yeah, event studies. Yeah, that's also a very interesting question because a lot of the studies when they're doing cost of capital, it's more of an exposed cost of capital. So it's you after disclosure, and then what would be the cost of capital? What would be the cost of capital like after disclosure change? And what we are doing here is we have this pre-posterior cost of capital, which is what would be the cost of capital look like in anticipation of disclosure. And then we have this exempted cost of capital, which is in anticipation of all the future disclosure, what would the cost of capital look like? So it will be interesting to see if you can tease out these components in event study. So the Christian et al. Accounting Review 2010, they actually I think in their discussion they provide some discussions about empirically how to tease out this pre-posterior cost of capital and ex-post cost of capital. And if you're interested, you could take a look into the discussions. But yes, I think this is, I mean, in principle, it's certainly testable using event studies. Yes.
Yes, another questions about the generalization of the result of the study. We can generalize the result, or there are some limited.
I'm sorry. In terms of generalization, I would say it may not necessarily be disclosure, because we talk about this kind of disclosure as financial disclosure, but it does not necessarily need to be disclosure about earnings or let's say cash flow. What it needs is it happens periodically, so you're in anticipation of that, and that in some way affects your payoff, affects the price, affects your payoff. For example, you could think about some sort of non-financial disclosure, because for example, SEC is actually requiring a lot of non-financial disclosure. For example, disclosure about cybersecurity, and then for example, disclosure about ESG, and those could also could have price impact. We don't directly model ESG, but if you think about let's say ESG has some cash flow impact on your long-term value, then it may affect your price. Or just some sort of investors, they don't like ESG. We don't really model here. You could think about some investors, they don't care about ESG. Some they care about ESG, which is kind of related to investor heterogeneity question that was asked previously. Then if your anticipation of such disclosure and such disclosure has price impact, and it would apply to those as well. Yes. So we talk about this as disclosure, but it's in a very general sense. So what is crucial is, first, it happens periodically, so you're in anticipation of that. The second thing is it has to have some price impact. So like people have to care about disclosure, investors have to care about disclosure. But whether it has to be earnings, whether it has to be to be cash flows, whether it has to be capital expenditures, it doesn't matter. Yeah.
Another question, what about what's your opinion about doing a study, a comparative study between the other country?
That's actually that may not be a bad idea. That actually may be a good idea, in a sense that you may be able to find more variations in terms of disclosure quality, and also maybe in terms of the variation in disclosure frequency, and also in terms of the variation of the percentage of short-term and long-term investors. But then, of course, the usual issue with doing cross-country studies is always, different countries, they have different institutional factors, and so whether or not, it's the institutional factors that are driving your results rather than the factors identified in the model.
Yeah. Thank you very much, Professor
Sure. Thank you very much, Mohammed. And then I see another one on the chat.
Yeah.
And so there is this comment from Chan Ge saying that tender offers are another setting where the first period information, the initial tender offer, is of low precision, and the second period information of a definitive merger agreement, somewhat anticipated, is of high precision regarding merger event. Actually, that's a very good example. I didn't think about that. It's related to the kind of a generalization question, because when we write this paper, we think about more of like a periodic public disclosure, but this this tender offer disclosure could be another one, and I think we could use that as another example. So thank you very much, Chan, for the comment. Yeah.
Yeah.
And thank you very much for having me. It's really a great pleasure to see so many people and interact with you and share my work.
Yeah, thank you very much, dear Professor Cho, for your, and thank you for your contribution. Thank you everyone joining us today, and thank you very much for taking the time to present to us today. It's been have been appreciated. Thank you very much, and I hope to see you soon in Egypt. You are very welcome.
Oh, sure. I would very much, would like to want to come to Egypt and see, many of the people in person and talk to you in person. Yeah.
You are very welcome.
Mhm.
Thank you very much.
Thank you.